Serving traders worldwide since 1998, TradersCoach.com provides educational services for traders and investors. We've developed trading software to help traders of every level improve their skills. Our site is dedicated to providing you with all the resources, software, and educational material you need to achieve your trading goals. It's because of our years of experience, attention to detail, and exceptional customer service that we're the right choice. Call us today.
Well, hello everyone, and hope you're all having a great Wednesday. We're broadcasting live from San Diego, California, and thank you for joining us live. And for those of you that are viewing the recording, thanks for watching. My name is Jean McDowell with TradersCoach.com, and welcome to Wednesday Night Live. Tonight, for Wednesday Night Live, we have with us for the first time Tony Zhang of optionsplay.com. And Tony is a specialist in the financial services industry with over a decade of experience spanning product development, research, and market strategist roles across equities, foreign exchange, and derivatives. Currently, Tony is the chief strategist for optionsplay and leads in the research and development of their optionsplay ideas and portfolio platform. And we're excited to have Tony here because actually Bennett just developed a brand new strategy that's using options play. And I think a lot of you folks here in the room, I can see you all here, Joy, of course, and Richard and a few others. Perry, I think you are doing this new cash flow strategy, which uses options play. So Tony's going to show us a lot about the platform. So for a moment, I'm going to turn this over to Bennett. He's actually joining us for Wednesday Night Live. So I'm excited about that. And Bennett's just going to give you all a hello and introduce Tony.
Gene, thanks. It's great to be here, folks. Welcome and thank you for coming. And I want a special thank you for Tony for being here to talk to our group here. It's great. All right. Well, I just want to give you a little insight. You know, option play software, I look at a lot of different softwares. And what I loved about options play is a couple things. One is it's very intuitive. It is a very simple yet complex software in that it covers all the angles. For example, depending on your time frame, you can actually modify some of the recommendations it gives us on the option play. And Tony will show you this later. But you can modify it depending on how long you think you're going to be in the trade. You can also look at the deltas, the Greeks on it. You can take a look at the vertical. It does vertical spreads for you. So, I mean, it's really cool. You don't have to have your book in front of you. You can just do the vertical spreads exactly how the system shows you, putting in different information, for example, strike price, expiration, and so forth. It also can do covered calls for you too and recommend which ones are the best to do that. So it's just a super platform. But what I love about it is it's so simple and intuitive. It's clean. It's not buggy. It's you can put in any symbols too and bring up information on those. So really super software. I'm really excited, Tony, you're going to be here, show us how to work it. And we're going to record this. So you know, for those new here that want to look at it again, we'll have that available to you as well. And also, too, we're going to have a link available for you because what we've been able to do, thanks to the folks at Options Play, is actually pass on a savings to you all, where you can actually save money on when you purchase the thing. And they have a great 30-day trial, the whole 9 yards. You can try it, see if you like it, guarantee you'll love it. But then at the end, they have a couple different plans, and I'm sure Tony will go over this, or Gene will go over this with you at the end. So thank you for being here. And Tony, I'm going to turn it over to you, and we'll talk to you all later.
Thank you so much, Gene. Thank you, Bennett. Great to be here. As they said, my name is Tony Zhang. I'm the chief strategist here at Options Play. Good evening and good morning to those of you that are in Australia. Today, what we're here to talk about is trading earnings with limited risk using options. Now, earnings season is mostly over, but we still have some big names up on deck over the next couple of weeks. So what we want to talk about is not necessarily trading this specific earnings season, but giving you guys the knowledge and the tools so that next earnings season, when you have stocks that you either own or stocks that you want to own going into earnings season, how to play, a bullish or bearish view on those stocks with limited risk going into earnings. So today we're going to go over a few different things, but at the end, what I really want to do is spend as much time as possible showing you options play so that you can see the platform in action and see the things that I'll teach you here in practice, because at the end of the day, the best way to learn how to trade options is by example. So before I get started, just by a quick raise of hands, how many of you currently trade options? Please type yes into the chat window. And for those of you that don't trade options, please type no into the chat window, just so I can get a sense for the audience here in the room. Okay, great. See quite a few yeses, a few nos. So for those of you that trade options, the strategies that I'll explain here today are going to be fairly simple. For those of you that are new to options trading, hopefully this inspires you to consider taking a look at options as a way to trade a directional view, because options truly give you the ability to leverage your capital while doing it so in a way with limited risk. And only options allow you to do it in this specific manner. So today what I'll do is I'll go through what strategies are suitable for earnings season, and also some examples. Now, before I get started, many of you may not have heard of options play. So as part of this new partnership that we're doing with Traders Coach, we are giving everyone a free 30-day trial to options play. You can sign up for this exclusive link here at the link that I have here on my screen, optionsplay.com/traderscoach. And if you sign up from that website, you will get a free 30-day trial and a 20% discount on your subscription after the 30 days if you choose to purchase, a 20% discount, which brings your monthly membership to just $60 a month, or an annual subscription down to just $400 a year. And included with this is a free 12-step options trading course to help you get started with learning how to trade options, as well as daily options trading ideas that we send out to customers. So you can get daily trading ideas sent to your inbox every morning so that you can get a sense for different strategies that we're trading, different outlooks that we have on the market, and see how they do for your portfolio. So those are the things that you're going to be able to get from signing up with that link here on your screen. And I'll come back to this at the very end for those of you that want to take a look at what we have to offer before you sign up. So let's go ahead and get started here. I'm going to kick off today by just talking a little bit about Q3 earnings season preview. This also includes a little bit about how earnings season has gone so far. Then we're going to talk about what option strategies are suitable for trading earnings. And once we understand which option strategies are suitable, then we'll talk a little bit about option pricing. It's really important to understand how option prices are affected before and after earnings in order to understand how to profit from these types of strategies. And then lastly, what I'll do is I'll talk a little bit about an earnings hedge and a stock repair strategy. This is useful for if you own the stock going into earnings, or if after earnings the stocks that you hold are at a loss, what are things you can do to potentially repair your position going after earnings. And then lastly, what I'll do is I'll try to spend a few minutes going through options play, showing you some real examples so that you can see how easy the platform is to use. So let's go ahead and get started. Just to give you a quick start as to what we expect. Last quarter, we saw flat sales growth pretty much across the board in the S&P 500. This was one of the first quarters that we saw a significant slowdown in corporate profits. And this was the slowest quarter we've seen in almost a decade. And we saw 15% of S&P companies say that they were hurt by the tariffs, up from 10% the previous quarter. So the trade war certainly was starting to affect corporate profits. And one of the interesting things that we saw from that Q2 earnings was actually the fact that we had relatively big positive moves on stocks that beat their earnings, but we didn't see a huge amount of negative moves when stocks missed their earnings. This was a bit of a departure from the norm, because over the last 4 or 5 quarters, we've seen these stocks that barely move when they beat earnings, but when they miss, we saw huge negative reactions, and that kind of flipped last quarter. So this quarter, trade deal is still going to be an uncertainty, and first quarter sales, we do expect some type of contraction. Now, what we have seen going into from the companies that have reported this quarter is that trend has seemingly reversed a little bit. Sales have started to grow a little bit. Corporate profits are not as weak as we had expected. And what we've seen is large cap stocks continue to show strength over small caps, even though that trend also has started to reverse a little bit over the last couple of weeks. Now, our expectation is still a modest beat on sales, but actually what we've seen in Q3 this year is actually a fairly surprising number of companies that have beat on sales and earnings. But usually it's guidance that the companies provide that give us the biggest moves after the fact. So what we typically look at these days is more guidance from the company rather than the actual beat or misses on the actual stock. So those are the things that we're looking for going into this Q3 earnings season. Now, with that, what I want to talk a little bit about is what are the suitable strategies to trade. Now, before we jump into the actual option strategies, I want to talk a little bit about earnings. What are earnings? Earnings are simply just when a stock reports its revenue, profits, and forward guidance to let you know how the financials are doing and what they expect going forward. And why should you consider trading earnings? Because it provides a binary event with extreme volatility. Now, usually we don't think of volatility as a good thing, but this is where volatility, if used correctly, can provide you with some benefits, because if you call the direction of the move correctly, you can make a profit very, very quickly. If you call the direction incorrect, you can have a large loss very, very quickly. So that's why we want to use options to try to trade earnings, because it allows us to take a directional view with leverage, but do so in a way that we have limited risk. And the key word here is limited risk. What that means is that we want to be able to get paid if we're right, but if we're wrong, we want to make sure we control how much we lose. So when you're using when you're using options to trade earnings, we typically want to choose 2 things. We have to pick an expiration date, we have to pick a strike price, and we have to pick a strategy. So when it comes to expiration dates, this is a good question that a lot of people ask is, how do you pick the appropriate expiration date on an earnings play? And the rule of thumb here is that you want to generally give yourself a little bit of room after the earnings date to buy an option strategy. So you generally want to give yourself at least 2 weeks after the earnings date in order because many times what we see is a stock might actually move on earnings, but have a considerable amount of time afterwards where it continues to move in that same direction. And you want to make sure that you are able to capture that eventual drift. So we usually tell users that when you're buying options for an earnings play, if options are next week, don't just buy a 1-week option, buy a 3-week option. Give yourself a little bit of time after the earnings announcement for the stock to move. And as far as strategy goes, today we're going to talk about a really simple strategy. We're just going to talk about buying a call or put option to speculate on the direction of that stock. Now, before I move on, I just want to make sure everyone is familiar with a call or put. Does everyone know what a call or put is before I move on? If you understand what a call or put option is, please type yes. If you're unfamiliar with a call or a put, please type no. Okay, I see a lot of yeses, great. Okay, so if everyone understands what a call or put is, let's move on to the next slide and let's talk a little bit about trading earnings, because trading earnings is difficult. It's not easy. It's what I call 1 step forward, 2 steps back. What I mean by that is you have one thing that's potentially working in your favor, while you have 2 things that are always going to be working against you. So you have a pretty big headwind trading going into earnings using options. So when we talk about options trading, when we talk about going into earnings, what we're basically expecting is if it's currently, let's say a stock is currently trading at $100. And if we expect the stock to beat its earnings, then what we're basically saying is we're expecting a move to the, whoops, we're expecting a move to the upside. So we're expecting the stock to either significantly rally or significantly decline if we expect the stock to miss on earnings. So this move that we expect the stock to make, that's the potential profit factor that we have on the underlying stock. So if the stock makes a large move on a beat or a miss, that is the potential for us to make money on that particular trade. However, when you trade an option, there are two things that are constantly working against you. And one of them works consistently regardless of whether you're trading earnings or not, and that's time decay. So when you buy a call or a put, you have time decay that's eroding the value of that option the longer you hold on to it. So time decay will always be a factor in any type of long options that you purchase, a call or a put. However, the second element that doesn't typically come into play other than during earnings is what we call volatility crush. Because right before earnings, there's a lot of uncertainty as to where the stock will be. It could be up 10%, it could be down 10%. So options tend to be very expensive. And the second that the earnings announcement comes out, that uncertainty goes away, and maybe the stock has jumped 10%. So now that uncertainty has gone away, the volatility is also significantly lower. So what happens is what we call a volatility crush. So the option will actually decrease in value the second that the earnings announcement comes out, and that also deflates the value of an option. So when you're buying that option, you want the value of that option to increase in order to profit. So the only way that you can make money is if the stock makes a large enough of a stock move in the direction that you expect it to, and that move is large enough to overcome the volatility crush and the time decay factor that's working against you. So it's fairly simple math. You have to have a large enough move to overcome the time decay and the volatility crush. Now, if that's a concept that you guys can understand, please type 1 into the chat window. Okay, I see a few ones, and if this concept doesn't make sense, please type 2, just so I can understand if anyone doesn't understand this concept. But it's fairly simple, and I'll define in the next slide how do you determine how big volatility crush and how big time decay is. But just the concept that you need to have a large enough move in one direction that overcomes what you lose to the volatility crush and lose to time decay. As long as you have a large enough move, that's how you can profit from trading earnings. Okay, looks like everyone has answered 1. Great. So let's move on to the next slide. Now that we understand the concept of the stock needs to move a large enough amount to overcome time decay and volatility crush, let's try to put some numbers behind all of this. Now, if any of you have ever traded options, you might be familiar with a term called the option Greeks. Now, the option Greeks tends to scare a lot of people off because, first of all, it's called the Greeks, which doesn't sound like something that most people understand, and it's expressed in numbers that tends to be somewhat confusing. So when we talk about option Greeks, there are 3 that are very important. Now, I'm going to talk about this from a conceptual perspective, meaning I don't expect you to have to remember how to do the math. I don't need you to remember how to do these calculations, but understand these concepts are important in order to understand how to trade options. So delta is the change in the price of the option with respect to the change in the price of the stock. So in that example before where we had a $100 stock, if we expect the stock to make a $10 move to the upside, how much money does the option move in that $10 move? That's what delta tells you. So if a call option shows you that it's got a delta of 0.5, what that means is that for a $10 move, the option will move $5 or half as much. The second delta that we need to be considerate of is vega, the change in the price of the option with respect to the change in volatility. So if the current volatility of a stock is currently trading at 20%, and after earnings, that implied volatility of that option decreases to, let's say, 18%, then that 2% move will tell you how much the value of the option will actually decrease by. So Greeks help you quantify these three concepts that I talked about: the direction of the stock, the volatility crush, and the vega. So vega tells you how much the price of the option will change with the change in volatility. So if you see a call option has a vega of 0.25, that means for every 1% the volatility decreases by, you'll lose 25 cents. So you have a 2% move in vol, you'll lose 50 cents. And lastly, theta. Theta tells you the change in the price of the option with respect to the change in time. So if you see a theta of 0.1 on your call option, that means this option will lose 10 cents every single day you hold on to it. So if you hold on to it for 7 days, you should see approximately 70 cents of that option erode. So with this, you can start doing some math. So you can say, how far do I think the stock's going to move? And that will calculate approximately how much profit you get from delta. And then you have to factor how much are you going to lose to vega and theta. And then it becomes a simple arithmetic calculation to say, am I getting enough change in the underlying stock to overcome the losses that I have from volatility and time decay? So this is really the point where we want to jump to options play, because again, the goal here is so that you never have to do these calculations on your own. Even I don't do these calculations on my own as a professional. There are tools that do this work for you, so there's no need for you to do the calculations. It's just important to understand the different factors that are affecting the price of your option around earnings. So with that, what I want to do is I want to jump over to options play before I continue with the slides to give you a sneak peek as to what you will receive as part of this new partnership that we have with Traders Coach. So the tool itself, the options play tool, is divided into 3 sections. We have trade ideas, watch list, and portfolio on the left-hand side of your screen. In the middle is our security analysis panel, which gives you summary technical analysis data on an underlying stock or ETF. And lastly, on the right-hand side, we have our trading and income tab. We call these 3 panels the what, the why, and the how of options trading, because when you start your morning, you want to know what symbols do I want to pay attention to. So we have trade ideas that are freshly scanned for you using technical analysis every single morning. We have pre-built watch lists so that you can use any of our pre-built watch lists or create your own. And we have a portfolio tool that allows us to track the trade ideas that we send out to users every single day so that you can see how those trades are tracking. The security analysis panel is designed to give you summary technical analysis data so that you can quickly see the 1 month and 6 month trend. You can see how that trend has changed over time at the bottom of your chart. You get relative strength rankings so that you can see how strong a stock is comparing to its overall market. And then lastly, important information such as earnings, dividends, and price action data here at the bottom. And everything else on the screen is really driven based off of your directional view on an underlying stock, because whenever you're trading options, the biggest exposure you have with an option strategy is usually delta, meaning the direction of the stock. So you can either select I'm bullish, and we'll show you 3 bullish strategies on the stock, or select I'm bearish, and we'll show you 3 bearish strategies. Now, for those of you that said that you've traded options, you're probably used to starting with a page that looks like this. It has every single expiration date, every single strike price, and it just lists it's just a lot of numbers. And from my perspective, if I show you this type of screen as a starting point, it's kind of like handing you a phone book and saying everything is in here, just go and figure it out yourself. Now, even as a professional, I have a pretty good sense when I look at an option chain where I want to start. But when it comes down to trying to understand how the value of that option will perform if the stock moves higher by 10%, moves down by 10%, those are things that are not easy to calculate. So the things I showed you before, delta, vega, theta, you can kind of do back of the envelope estimations, but those are estimations at best. And it's really difficult to juggle this in your head when you're trying to compare different expiration dates, different strike prices, or even if you're trying to compare different strategies. It becomes almost next to impossible to do it in your head off of an option chain. And that's why we created Options Play, because I was sick of doing these calculations in my head. I couldn't do all the calculations that I really needed to. So we set up a tool that really allowed us to do the trading that we wanted to do. And that's what you're that's what you're able to utilize today. And what I want to do is I want to show you how easy it is to utilize this tool to, number one, find a starting point so that you can see, okay, I'm bullish on a stock. Let me see what strategies make sense. We not only select the strategies for you, we also select the expiration date and a strike price based on our best practices as to how we would start if we were looking at an option chain. So back in the day when I was bullish on a stock and I was looking at a vertical spread, I knew that I always wanted to buy a slightly in the money call, and then I want to sell a call that was roughly about a 15 to 20 delta call or put against that long call to offset the cost of that vertical. So what we've done is we've taken that strategy and we've coded it directly onto the platform. So for any symbol you type in, all you have to do is click on either I'm bullish and see 3 bullish strategies, or I'm bearish and see 3 bearish strategies based on the best practices that we use as professionals. And you get to then utilize our P&L simulator that allows you to say, well, if I'm bearish on this particular stock and I think it will move down from 138 to 132, how much money do I actually make from each one of these 3 strategies? How do I compare the 3 side by side and see how they perform? And that's really why we built the P&L simulator, because I was sick of doing these types of calculations in my head and doing back of the envelope calculations. It just got to be too much. So we built a tool that told us exactly how much money we would make or lose if the trade went in our favor or if it went against us. And for many of you that trade options, I tend to find a lot of users kind of guess how much risk they're taking or how much potential reward they have in a trade. They don't really know down to the dollar how much they're actually risking and what is their potential reward if they are right. And chances are, you might be able to do some of those calculations at expiration. Very difficult to do those things prior to expiration. And again, that's what I want to show you here today, is how you can utilize this tool to type in any stock. So let's say we look at a stock like NVIDIA that's posting earnings here next week on November 14th. And let's take a look at, if you wanted to trade NVIDIA going into earnings, how you can do it in a way that has limited risk. So here, if I'm bullish on NVIDIA, which is a pretty strong stock, it's got a technical score of 9, telling me this is one of the strongest stocks in the market. And the 1 month and 6 month trend is bullish. And you can see it's been consistently bullish here since mid-August here. Those trends have basically been consistently bullish, very strong stock. In my opinion, likely to outperform going into earnings. So I'm likely to choose I'm bullish on this particular trade. And for this, I'll be able to see I can buy 100 shares of the stock right now for $20,000. I can buy a call option for $1,300, or I can buy a call spread for $1,066. Now, let's not even look at the call spread for 1 minute, because for those of you that are brand new to options trading, let's make this as simple as possible. Let's just compare buying 100 shares of the stock to buying a call option, because those are 2 strategies that you might consider if you're bullish on a stock going into earnings. Now, I would never own the stock going into earnings personally, because that leaves me quite exposed on the overall trade. But let's actually put the 2 side by side and see how they actually perform. Now, NVIDIA reports earnings on November 14th, which is just 8 days away. So what I want to do is I want to say, well, the stock's trading at 207 right now. What happens if this stock makes a move to the upside? And I can look at previous, as you can see, there was a previous high here around 220 or so, or maybe 234 to the upside. That I think would be an extended target on the stock moving higher on earnings. Now, there are many different ways that you can price how you think a stock will perform going into earnings, based on estimates, based on your technical levels. I tend to be more technical focused when it comes to trading, but there's no shortage of ways that you can determine a target price. Some of you like to use Elliott wave, some of you like to use more fundamental type analysis. Regardless of how you come about your views, you can plug them into optionsplay and say, well, what happens if I think the stock is going to rally to, let's say, $230 after earnings, because I think they're going to beat earnings. And what you want to do is you want to factor into the 2 other things that I talked about, which is time decay and volatility crush. So as you can see here, our P&L simulator allows you to simulate 3 different things. Where do you think the stock will go? When do you think it will make that move by? So we know that it reports earnings on November 14th. So maybe we want to pick a day that's a few days after, maybe the Monday or Tuesday after. So let's say we think a week after earnings on let's say the 21st, a week after earnings, and the current implied volatility of NVIDIA is pretty high, around 39%. We know that after earnings, that volatility will come down because the uncertainty factor around where earnings will be gone. So we can always estimate maybe a decrease in the volatility. And then what optionsplay does is it calculates for you the expected profit or loss on the underlying stock or option. So as you can see here, if the stock rallies to 230 on earnings, you make about a 10% return on the underlying stock. So about a $2,100 profit on your $20,000 investment. Conversely here, if you bought a call option, you're looking at a $1,300 profit on a $1,300 investment, which is a 100% return. So as you can see right off the bat, you're going to leverage your money 10 to 1 by buying the call option versus buying that stock. Now, that is, in my opinion, a good outcome, meaning the stock does exactly what you expect it to. It rises on earnings, and even with the volatility crush and even with the time decay, you're still making a very nice profit on this overall trade. But whenever it comes to trading, the first thing I typically want to look at is how much risk do I have? Meaning, what happens if NVIDIA completely falls flat on their earnings and it pulls back to, let's say, this 187, 190 resistance level that it was just broke above here in early October. So let's say I think it's going to maybe fall down to 190. That's the risk that I see, right? If the stock does decline to 190, as you can see here, if I bought the stock, I would lose $1,800 of my investment. If I bought the call option, I'm only losing $1,100. So I'm actually risking less money on the call option than I do on the individual stock. And the good thing about the on the option strategy is that in the event, let's just say that it's fairly unlikely, but in the event there is a catastrophic loss and NVIDIA reports really poor earnings and provides really bad guidance, maybe trade wars have affected them bigger than we had anticipated, and the stock really plummets to, let's say, 160. As you can see here, if you bought the stock, you would just keep losing more and more money the further the stock tumbles. On the call option, the most you can lose is the $1,300. No matter what, that's the most you can lose. And that is the benefit that you get when you're trading options. And what optionsplay here is designed to do is provide you with a clear understanding as to how much money can you potentially make on a trade, and more importantly, how much money are you risking if you are wrong on that particular trade. And then you can actually use the P&L simulator to say, well, how far does the stock need to move on earnings in order for it to be interesting for me? Because you can also use the slider to say, well, what happens if the stock goes up to 215? So it goes from 207 to 215, which is about an $8 move. As you can see here, if the stock moves $8 higher by November 21st, and that's after earnings and the volatility comes down a little, as you can see, I make a 5% return. Only a $72 profit on my $1,300 investment. What that tells me is that if I expect the stock to move modestly higher, I should not buy this option because it doesn't provide me with enough return. And that's something that if you were looking at an option chain, I would imagine that it would be very, very difficult for you to be able to tell that if the stock moved up $7 between now and earnings date, that you would only make a 5% return. I know I couldn't do that math in my head. And that's why we created optionsplay, so that you can ask yourself, how far do I think the stock is going to go? Or set up a scenario to say, well, I think the stock really needs to move to about 225 or so before this gets interesting for me. So then I can ask myself, do I think NVIDIA is going to make it all the way up to 225? If I do, then maybe I'll take this trade. If I don't, then that also tells you it's not the right trade to make, because the tool here is not necessarily designed to get you to trade options every time. It's here to help you make informed decisions as to whether the option strategy is the right strategy for you, because I'll be honest, there are plenty of times where the option strategy just does not make sense. And this tool is really designed from the ground up to try to make that process as easy and as intuitive and as visual as possible so that it's extremely clear to you as to whether or not an option strategy makes sense for you. So with that, what I'm going to do is I'm going to jump over to the slides back real quick. I want to talk a little bit about the things that I discussed here today. So up till now, I've only talked about a simple strategy, buying a long call or put going into earnings. And the reason that we like this particular trade going into earnings is because it provides you with unlimited profit potential. So if the stock keeps going higher and higher, you make more and more money. So if you expect a big move on earnings, a long call or put is typically suitable for these big moves. Now, this strategy does put a significant amount of capital at risk. So, in that NVIDIA example, you're still putting up $1,300 of risk, right? You're risking $1,300 on that trade. It's not a small amount, so you have to be careful when you're thinking about these types of strategies. There is a second strategy for those of you that are a bit more experienced with trading, is trading a long call vertical or a long put vertical. Now, this gives you similar type, it actually gives you more leverage, but it limits your profit potential. So you only get profit potential up to a certain point, and then anything beyond that, you don't get to participate in. So, however, what this is typically used for is more modest or slower moving stocks. So think about the blue chip stocks. And I'm looking at the list of blue chip stocks that are reporting earnings. NVIDIA is one of those I would say high beta stocks. They're likely going to make a big move. But if you look at stocks like Walmart or Home Depot, they don't make such big moves on earnings. They usually might move 3-4%. They're not the type of stocks that will move 10-15% on earnings. So for those stocks, you might want to trade a long call vertical or a long put vertical because it also puts a smaller amount of risk on the particular trade. And lastly, like we said before, whenever you're trading earnings, you do want to pick an expiration that's at least 1 to 2 weeks after earnings on the individual trade. Now, I just want to check with everyone. Does that make sense? If that makes sense, please type 2 into the chat window. Okay, I've got a few 2s here. Great. So let's go ahead and move on. I just want to discuss a few things before I jump over to options play and show you a few more examples. So what I want to talk a little bit about are 2 things for those of you that are trading earnings, because not everyone necessarily has a view going into earnings, but you might have a stock that you own that reports earnings 4 times a year. So one of the things that you can also consider if you own a stock and maybe you're concerned about a stock that you've owned and it's going to pull back on earnings. Maybe you own a stock like Netflix and you're concerned, you like the stock, but you're concerned that on earnings, you're going to take a big loss. One of the things that you can do with options is you can use it as an insurance policy. You can buy an insurance policy going into earnings by buying a put option on a stock or ETF that you own. And this generally provides you with what we consider a catastrophic insurance against big corrections. And usually this is what we call an imperfect partial hedge, meaning it's not going to provide you dollar for dollar hedge. So if you might end up losing, let's say $1,000 on the stock, and you might make back $400 or $500 on the option. It doesn't perfectly hedge your portfolio, but it certainly provides some protection. And the rule of thumb here is if you want to buy a put option on going into earnings, is you want to buy it right before earnings. You don't want to buy it a month before earnings. You want to buy it right before earnings, and you want to exit immediately after. So you want to buy this insurance policy for a short amount of time as possible, because insurance is very expensive. You have time decay working against you, you have volatility crush working against you, and you want to make sure that you minimize both of those things, and the best way to do that is to buy right before earnings and exit right after earnings. Now for this type of strategy, if you're interested, you want to buy out of the money put options. You don't want to pay very much. You want to buy about a 20 to 30 delta call or put. If you're concerned about the stock making, just to put a 20 to 30 delta put that protects you. Usually you want to buy 3 to 4 weeks after expiration. You certainly don't want to hold that trade 3 to 4 weeks. You just want to hold on to that trade maybe for a day or two. And what this does is it provides you with a cheap insurance policy so that if you have a catastrophic move to the downside, you are protected to some degree on that underlying stock. So that is for those of you that maybe you're not looking to speculate on earnings, but you are concerned that earnings are going to put a dent in your portfolio. And this is one way to potentially protect your portfolio against that. And lastly, for those of you that own stocks going into earnings, and maybe after earnings, you find yourself down 10% on a stock. How can you use earnings? How can you use options to potentially repair your stock? Now, first, I should qualify this strategy. It only works if after the downside move, you expect it to now recover. Meaning if you expect the stock to continue moving lower, you should not try to repair the stock, because this strategy does not prevent you from taking further losses. It doesn't provide any downside protection. What it does is it tries to gets your position back to break even if the stock rallies modestly. And what you can do is if you own some stock, let's say you own 100 shares of XYZ, maybe you bought it at 110 and earnings, it's now down to $100, and maybe you think it's going to rally. Let's say you have a $100 stock and the stock declines to $90 after earnings, and maybe you think the stock's going to rally back up to 95 or 97, but you're not sure it's going to get all the way back up to the original $100 cost basis that you have. So one of the things that you can do utilizing options is you can sell a ratio spread. Now, a ratio spread sounds really complicated, and even for me, I don't like to think about ratio spreads. What I want to do is I want to break this up into two strategies so that hopefully you can understand it. So you own 100 shares of the stock at $100. What you want to do is you want to first sell a cover call at your original break-even price. So if you own the stock originally at $100, you want to sell a cover call at the original $100. And then what you want to do is you want to take the money that you receive in income on that cover call to try to buy a debit spread at the current stock price. So if the stock is currently, you bought it on $100, it's declined down to $90. What you want to do is you want to sell a cover call at the original cost basis at $100 a share. And then what you want to do is you basically want to buy a $90 call, a debit spread, buy a $90 call and sell another 100 strike call against the $90 call, creating a call debit spread. And that combination of the cover call and the call debit spread provides you with what's called a call ratio spread. Now, again, don't worry about the mechanics or the terminology, but the goal here is to basically finance the purchase of a call option with the sale of two call options at your original cost basis price. And you want to do it at a point where you're not really paying anything for this. And what it does is it provides leverage on your position so that if the stock rallies just halfway to $95, you will actually break even on your stock. Now, if the stock makes it all the way back up to 100, you will actually make a profit. As opposed to originally, if it just got back to 100, you break even. On a repair strategy, you could break even at a lower price and potentially even make a profit if the stock does rally to 100. And what you're doing here is you're basically trading off any further profits beyond 100. So if the stock really rockets and goes back up to 120, you're not going to participate in any of that because your profits are going to be capped. What you've effectively done is you've traded away the upside return in exchange for trying to get a better break-even price early on this particular stock. So that is another way that you can utilize options going into earnings. Now, I've gone over a lot of things here today. I don't expect everyone to remember everything, but that's why we here at OptionsPlay do weekly options education webinars, just like this one here, when you sign up for a free trial or sign up for a subscription. So we cover lots of different option strategies, whether you want to generate income using cover calls, cash secured puts, or for those of you that are a bit more advanced, trading vertical spreads, debit spreads, credit spreads, earnings, repair strategies. We have separate webinars on all of these topics so that you can learn more. Today was meant more as a teaser to show you all the different things that you can do with options play and how easy it is to pick any stock. And let's take a look at Walmart real quick. Walmart reports earnings also here in about a week or so. I'm just picking stocks that are big cap names that most people are familiar with. There are a few smaller cap names that I think maybe are more interesting. But let's say consumers have been really, really strong this season. I think that Walmart is very clearly poised for potential breakout to all-time highs on earnings. So let's take a look at trading earnings on Walmart. Trading at around 119 right now, so 100 shares will cost you 11 grand, 12 grand. Buying a call option only costs you $610. That means that you can take a bullish bet on Walmart going into earnings for just a fraction, about 5% of the underlying stock price is all you're going to risk going into earnings. And what you see here is that if, let's say, the stock maybe makes a brand new 52-week high to 123, a week after earnings, which we said was around November 21st, 22nd or so, and the volatility on Walmart is about 19, almost 20%. So we know that volatility is going to come down a little. Now that's not an exact science, but we usually see at least about a 10 to 20% reduction in volatility going after earnings. And as you can see here, if the stock does rally to $123, which is about $3.50 from the current price, a week after earnings and volatility comes down a little, I'm looking at about a 2.7% return on the stock. I'm looking at about a 33% return on the call option. Now, certainly that outperforms the stock, but in my opinion, 33% return on a call option going into earnings is not really that attractive. I'm really looking for something that's closer to 60 to 100% gain if I am right on this individual trade. So this is a trade that I personally probably would not take because I probably don't believe that Walmart's going to hit 126 on earnings, but if it did, as you can see here, now it looks more interesting. But I think that's a pretty tall order for a stock like Walmart to make that kind of move going into the current market environment right now. But this allows me to quickly decide, okay, Walmart's not a trade that I want to make, and maybe I'll move on to the next one. Maybe let's look at a one that's a little bit more, maybe has a little bit more potential here. TJX. Some of these discount stocks have been discount retailers have been doing really well. Look at Dollar General, look at Dollar Tree. These are the stocks that have really performed well that seemingly do not have a lot of exposure to China. So buying 100 shares of that stock is $5,900 versus $280 for that call option. So if I think the stock maybe might rally to, let's say, $63 or so, make a new 52-week high. Same thing a week after earnings. This reports earnings on November 19th. So let's say I'm looking at the 26th and volatility comes down a little. Now, as you can see, I'm looking at a 98% return versus a 6% return on the stock. These are the types of returns that I would typically be looking for to determine whether or not this is a strategy that I want to trade. And more importantly, I also want to understand that if the stock declines back to $54, how much do I risk? Here I'm risking $522 on the stock. Here I'm risking $266 on the call option. So about half is what I would risk on the underlying stock. So this is really where you can utilize this tool, and you can use it for anything other than earnings as well. Let's say earnings are over and maybe you're just really bullish on Apple. You want to see how can I take how can I take a further bullish view on Apple with a limited amount of risk? And I think this is probably a better use case in the short run because earnings season is almost over, but especially on these high stocks that are very overbought, but have, in your opinion, maybe still a strong probability of the stock continuing to move higher. How do you take advantage of that move higher with the least amount of risk? And the answer is using strategies like a call vertical. So Apple's trading at 257 right now. Maybe I think the stock's going to continue moving up to 270 by the December date. So as you can see, I'm looking at a $1,200, 4% return on the stock, 88% return on the call, 117% return on the call vertical. And more importantly, if I'm wrong and the stock pulls back, and I could see how this stock could pull back easily to 225 very quickly if markets turn sour. If you had bought the stock, you're looking at a $3,200 loss. If you bought a call option, a $795 loss. A call vertical, only a $689 loss. So not only do I have a significant upside leverage to the upside by buying that call vertical, I actually risk the least amount of money on the strategy. And that's why this strategy has the highest options play score, because it tells you the risk to reward of a trade given with the current market environment, showing you what the potential rewards are, what the potential risks are, and balance it with each other to let you know what the true risk to reward of a strategy is. So that's just a very, very quick overview of the platform itself, how you can utilize it. And I've only been able to scratch the surface because there are so many other things like income strategies, the ability to modify your strategy and change different expiration dates, strike prices, and allow you to customize your strategy. So for those of you that like to trade condors or butterflies, you can quickly modify strategies very, very quickly with the click of a mouse and move strategies left and right without having to constantly deal with drop downs and option chains to figure out what you want to trade. Everything was designed from the ground up to really allow you to explore and play around with options. So with that, I want to thank everyone for taking the time out here this evening to listen to us talk about what we have to offer. And I hope that you consider giving us a try by signing up at optionsplay.com/traderscoach, which again gives you a free 30-day trial to OptionsPlay and a 20% discount to the subscription if you choose to subscribe. And as again, part of that, what you do receive is our daily trading ideas that we send out to customers weekly. Every single week we do options education webinars like the one that you're on right now, and we provide income reports, weekly cover call and short put scans for you every single Monday morning when you're likely going to be selling cover calls, and access to the whole platform that I just showed you here before. So with that, thank you so much for taking the time out here this afternoon. At this point, what I'll do is I'll answer any questions that you guys might have regarding the Options Play platform or trading earnings or just options in general. Please feel free to submit any questions you have into the chat window.
Boy, Tony, what a great presentation.
Thank you so much, Jean.
So there were a few questions. I don't know. Do you want me to read them out, or do you want to read them from the questions area? I don't know. Sometimes the scrolling is a little challenging.
Yeah, I'll read them. Looks like Joy is asking, does that mean an expiration 3 to 4 weeks out? So Joy, if the earnings that you're trading is a week from today, then yes, you want to buy an expiration that's about 3 to 4 weeks out. But if you're trading something that has earnings in 3 weeks from today, then you might want to buy a 5 or 6 week expiration. So it's just 2 to 3 weeks after the expiration date of the stock that you're trading. James is asking, shouldn't we buy put protection a bit earlier before it becomes more expensive, the higher volatility right before earnings? So James, that's my point, is that yeah, sure, you can buy it a month before, but you're going to have time decay during that whole month. So the increase in volatility right before earnings does not impact volatility, does not impact the price of your option that much. So as you can see here, Apple currently is trading at a vol of 19, and that call is trading at, as you can see, it's let's just say the current stock is right here at 257. So even if volatility increases a lot, and let's go, let's say halfway into earnings, as you can see, the difference in price that you pay is just, less than $50 usually. So in a big move in volatility. But what you're going to lose is you're going to lose hundreds of dollars to time decay. So would you rather pay an extra $100 because it's more volatile, or would you rather pay another $500 in time decay? Time decay is really what eats away at your at your options position, and many times you don't know what your time decay is if you're looking at a page that looks like this. You really have no way to get a sense for that, and that's why we created options play, so that you can decide for yourself, well, do I want to pay an extra $100 because it's more expensive right before earnings, or do I want to pay $500 in time decay by holding on to that put for a whole month? And my answer is, don't hold on to it for a whole month. Buy the more expensive protection, but only buy it for a couple of days. That's my point, James. I hope that answered your question. Scott is saying, can we put our own theoretical trade like a straddle? Absolutely. So you can click on modify here. You can use our strategy constructor. You can short a straddle. You can go long a straddle. You can do any of these things. And just by the click of a mouse, you can set up a short straddle. You can set up a long straddle. You can move the strikes left. You can move all the strikes up, all by the click of a mouse. You can change the different expiration dates. We've really made this as easy as possible for you to compare any three strategies side by side. So if you want to compare a straddle to a, I don't know, a short call butterfly, you can do all of that by the click of a mouse. Change the different expiration dates, the wingspans, all of that just by the click of a mouse. So Scott, I hope that answered your question. Chris is saying, given the high returns, why is the options play score only around 80 to 88? So the high returns is based on your outlook, right? So if you buy let's go back to the other strategies here. If you buy a call option and the stock shoots up by 13%, yeah, your call option is going to be worth a lot of money, but that's based on your outlook of the stock going up 10%, but that's may not happen. Our options play score is accounting for, or our options play score does not have a directional view. It's assuming an equal probability of the stock moving 10% higher and an equal probability of the stock moving 10% lower. And what we're looking at is how that strategy performs in all conditions. So the options play score is not accounting for your directional outlook. The 100% return is based purely on your directional outlook. So those are two completely different things. And the options play score tells you whether an option is cheap or expensive. Because the more expensive an option is, the less likely you're going to have a good outcome. But it's still possible to have an outcome, a good outcome, because no matter how expensive that option is, if the stock makes a big enough move, you'll make enough profit. So Chris, I hope that answered your question. Joy, Peter, thank you so much. I really appreciate that. Scott, about earnings straddles, I hope that I showed you how to set up a straddle. You can go long a straddle here. I will say, buying straddles going into earnings is a losing proposition in the long run. You basically have double the amount of time premium, you have double the amount of time decay, and you have double the amount of volatility crush, but you still only have one directional move in your favor. So I never recommend trading straddles going into earnings. James is saying, could you show us how a repair strategy works again? Sure, I actually have a good one for you. So let's take a look at something like IBM. This was an example that I gave before. The stock was originally trading about 142. Well, actually, let's take maybe a slightly less boring stock. What's a less boring stock? Let's look at Netflix. Whoops. Netflix certainly took a bit of a loss going into earnings. Let's say you bought Netflix stock at let's say 305, and it's now trading at 288 after earnings, and you think it's going to rally mildly, but you don't think it's going to make it all the way back to 305 or 310, maybe where your cost basis is. So what you can do is you can short you can sell a 1/2 call ratio. And what you want to do is you want to sell at the original cost basis. So let's say you sold 305, and what you want to do is you want to use that to buy a 285 or 290, which is the current cost basis of the stock, the current price of the stock. So as you can see, even if you sold 2 contracts of the 305, you're only bringing in a little over a little under $12, but you have to pay $14.75 to buy the at the money call. So maybe you might want to buy a 290 call. So a call that's actually closer to the current price, which is at 290. So what you're basically doing is you're financing the purchase of an at the money call, which is the 290 call, which is costing you $1,200, by selling 2 calls at the original cost basis of your stock. And you want to make sure that these 2 come out to be a trade cost that's very close to 0. And what I mean by that is, if let's say you own this stock at 360, you're not going to be able to do this trade at 360, because if you sold the cover call at 360, you're only bringing in 30 cents in premium. That's not even close to paying an at the money call. So this only works when you're down about 5%, 7% at most. Here you're down about $15 on the trade. You can repair that strategy. So basically, if this stock rallies halfway to your original cost basis, so let's say it rallies back up to, let's say, 293, 294, or no, actually a little further, about 296 maybe or so, you would make approximately $700, which would offset the roughly $700 loss that you would have from your original 305 cost basis. So, you know, a repair strategy is something that I take a whole webinar typically to explain. It's not something that's easy to do in just a few minutes, but it is a strategy that works when you have a small loss, about 5 to 7%. If you're down 25%, don't even think about trying to repair a strategy. And again, it only works if you do expect the stock to mildly rally back up from the current place. If you think it's going to continue moving lower, you got to get out. Don't try to repair it, because it's not going to work if the stock keeps moving lower and lower. Is trading a vertical call spread before ex-dividend a good strategy? So I generally don't think that it's a good or bad strategy before ex-dividend, because it doesn't affect the stock price that much, unless you're talking about a huge dividend in some stock. But generally speaking, it's not something that we consider as to whether or not we would trade a vertical spread, because the difference in P&L is relatively nominal compared to the P&L that we would actually receive from trading a vertical spread. Straddles are like betting one each team to win in any sporting event. Yeah, exactly. Meaning you're gonna pay through the teeth to bet, you know, both one team is going to win on each side. In the long run, it's a losing proposition. Is buying a narrow strangle before earnings a good strategy? Again, no, because of the fact that you have doubled the time premium and the double volatility crush. And a strangle is even more difficult to make money because your deltas are even lower. So you would have to even a larger magnitude move to make money. James, you're very welcome. Fran is asking, what are your selected portfolios? So our portfolios track the trades that we send out. So we track 2 different types of trades. We send out trades 4 days a week, and then we also highlight the trades that are done on CNBC's options action every Friday. So we have 2 portfolios that track the current trades that we have sent out and the options actions trade that the CNBC folks have sent out. Those are the last questions. Any other questions before I sign off for the evening?
A lot of great questions, huh?
Yeah, great questions. Repair strategy. You know, this is a topic that I've recently started doing, but like I said, it's a strategy that I need typically a whole nother webinar to select. A lot of great questions about earnings and straddles, and the questions about, you know, whether or not to buy put protection a month before or a day before. I hope that I answered all those questions.
Well, I think we'll have to have you back to do a whole repair strategy seminar.
That is a very popular topic, but I will say most people leave that webinar disappointed because there's no magic pill to repair a strategy on.
That's funny. Well, I have a couple of questions if you have a minute.
Sure.
Excellent. Okay, so Bennett just popped his head into my office and he said, well, check with Tony on the data feed, meaning I I think you get free data. So when Bennett signed up for his 30-day trial, he got a free 30-day data feed. And then after you go for the real time, after you go for your regular subscription and you pay, just talk to us about the data feed. And then a couple of other people, I think Larry was wanting to know what is the actual pricing structure. So maybe you could bring up the slide on that just so everyone understands what the price is after the 20% discount.
Sure. So as far as your free 30-day trial, currently you get a delayed feed on your options and equities. Now, right now, we actually only offer delayed even for a subscriber, but that is changing in the next month. And I'm actually in the process of testing that right now, but we are going to offer real-time equities and options for paying subscribers. And for a paying subscription, with the Traders Coach discount, it comes out to $60 a month or $400 a year. So that's with the discount. You have both choices of either going for a monthly option at $60 a month or the annual option at $400 a year.
Well, excellent. So Larry, does that answer your question? Just give us a little text message. And then I have another question from one of your very happy current subscribers. She's saying, boy, I want to get in on the special 20% off because I'm paying full price. Her name is Sandra. And so I'm wondering, and I guess that what I'm saying to everybody else in the room, you probably want to, if you want to try this and get the 20% off, do it now. Now, I posted the link, I'll post it again, but definitely do it now because it might not be here forever. And we don't want to end up like Sandra and then have to pay full price. So my question to you, Tony, is can Sandra get the discount? Sandra is still in the room. So Sandra, type us a hello or whatever, and Tony will answer your question.
So Sandra, if you don't mind, if you could send me an email at info@optionsplay.com. I just want to look at your account before I give you an answer to that. So if you can send me an email at info@optionsplay.com, I'll be able to take a look at your account and give you an answer offline.
All righty. Well, there you go. I think that's everything. So any more questions?
Joy, you have to sign up for free trial now. You don't have to sign up for the subscription now. As long as you sign up for the free trial, you will have access to the discount when you choose to subscribe. So just sign up for the free trial. You don't need a credit card to do it, and that'll get you started.
Yeah, Ben did want to mention, he thought that was great. He didn't have to put his credit card in, so. And then Richard's saying, I thought only the people who got the cash flow strategy were getting the special deal. Well, Richard, we're being generous and we're going to let everybody who attends this event get it as well. So a lot of the cash flow strategy people, though, did sign up already. So that's kind of cool. Oh, that's a good question, Scott. So Scott wants to know, is there a data charge on top of the subscription price?
No.
All right. All right, well, I think that's a wrap. This has been recorded, and we will be posting the recording tomorrow. And Tony, you have done such a terrific job. We'd love to have you back.
I would love to be back. It'll have to be in a couple of months. I have a pretty crazy travel schedule coming up, but I would love to come back and do another session like this again for you guys.
All right, well, we'll have to do it in the new year, in 2020. We will have Tony back. So great questions, everybody. Thank you so much for all your participation. And I think that was a great event.
Thank you so much, Jean. Thank you so much, everyone. I hope you guys have a great evening, and I'll see you on the next webinar.
All right, Tony, have a great night. Everybody, thanks for joining us. Have a great night.